When individuals or businesses apply for credit, lenders don't rely on just one factor. Instead, they evaluate borrowers using a framework known as the 5 C's of credit: character, capacity, capital, collateral, and conditions. In this video, we'll walk through realistic lending scenarios and evaluate each borrower using the 5 C's. As you watch, think like a lender and decide what you would do. Before we look at the scenarios, let's review the 5 factors lenders consider. Character: will the borrower repay the loan? Capacity: can the borrower afford the payments? Capital: how much money does the borrower have invested? Collateral: what assets secure the loan? Conditions: why is the loan needed and what's happening in the economy? Now let's apply these to real borrowers. Scenario 1. First-time auto loan applicant. Maria Lopez, age 23, recent college graduate. Her loan request is $22,000. The purpose is to purchase a reliable vehicle to commute to her new full-time job, and she would like a 60-month auto loan. 5. C's walkthrough character. Maria has only 2 years of credit history, consisting of a student credit card and a small student loan. She has no late payments, but her credit file is thin. Capacity: she earns $48,000 annually and has minimal monthly debt. Her debt-to-income ratio is low. Capital: Maria is making a $3,000 down payment from her savings. Collateral: the vehicle itself serves as collateral. Conditions: the loan supports reliable transportation for employment. A low-risk and common loan purpose. Lender decision: approve with conditions. Maria's limited credit history increases risks slightly, but strong income and a down payment support approval. The lender may charge a higher interest rate. Scenario 2. Small business startup loan for Jake Thompson, an aspiring entrepreneur. He is requesting a loan in the amount of $50,000 to purchase a food truck, kitchen equipment, and initial inventory with a 5-year small business loan. His 5 C's walkthrough. Jake's character. Jake has fair personal credit and no major delinquencies. He has 10 years of experience working in food service. Capacity: the business is brand new, so future cash flow is projected, not proven. Capital: Jake has invested $20,000 of his own savings into the startup. Collateral: the food truck and equipment can be pledged as collateral. Conditions: the local market shows strong demand for mobile food vendors. Lender decision: approve with conditions. Startup risk is high, but personal investment and collateral reduce lender exposure. The lender may require a personal guarantee or reduce the loan amount. Scenario 3. High income and poor credit history. Tanya Williams is a senior marketing executive requesting a $15,000 personal loan for travel and discretionary expenses, with a 3-year term. Tanya's 5 C's walkthrough. Character: Tanya has multiple late payments and a prior loan default on her credit report. Capacity: she earns over $95,000 annually and has steady employment. Capital: moderate personal savings, but none committed to this loan. Collateral: no collateral offered. Conditions: the loan is non-essential and discretionary. Lender decision: deny. Despite strong income, poor repayment history is a major red flag. A lender may reconsider with collateral or a co-signer. Scenario 4. Established business expansion. Applicant is Greenway Outfitters, a local retail business that has been in operation for 5 years. Greenway is requesting a $120,000 loan in the amount of $120,000 to open a second retail location with a 7-year commercial loan. Greenway's 5 C's walkthrough. Character: the business has a strong repayment history with prior loans. Capacity: consistent profits and positive cash flow for multiple years. Capital: owner is reinvesting retained earnings into the expansion. Collateral: inventory, fixtures, and equipment pledged. Conditions: local economy and consumer demand are strong. Lender decision: approve. This borrower is strong across all 5 C's and represents low lending risk. Scenario 5. Strong collateral but weak income. Alex Morgan is a homeowner applying for a $30,000 short-term loan to cover living expenses after losing his job with a 2 to 3 year secured loan. Alex's 5 C's walkthrough. Character. Alex has a long history of on-time payments. Capacity. Currently unemployed, making repayment uncertain. Capital. Significant equity in a fully paid-off home. Collateral. Home pledged as collateral. Conditions. Temporary financial hardship with expectation of reemployment. Lender decision. Approve with conditions. The lender may approve a secured loan with strict terms due to strong collateral but weak capacity. Scenario 6. Seasonal Business Loan. Prairie Lawn and Landscape, LLC, owned by Chris Miller, has been in business for 4 years. They are applying for a $40,000 loan to cover off-season operating expenses, equipment maintenance, and payroll during winter months. Prairie Lawn and Landscape is looking to secure a 3-year small business loan with a seasonal repayment structure. Prairie's 5 C's Walkthrough. Character. The business has a solid repayment history with prior loans and no late payments. The owner has good personal and business credit. Capacity. Cash flow is strong during spring and summer, but drops significantly in winter. Annual revenue is consistent, year over year, but monthly income fluctuates. Capital. The owner has reinvested profits into the business and maintains a cash reserve. Collateral. Landscaping equipment, trailers, and vehicles can be pledged as collateral. Conditions. The landscaping industry is highly seasonal, which lenders recognize as a normal business cycle rather than a red flag. Strongest and weakest C's. Strongest C, character. Weakest C, capacity, seasonal cash flow. Lender decision, approve with conditions. Because the lender understands the seasonal nature of the business, they may approve the loan with adjusted repayment terms, such as lower payments during winter and higher payments during peak seasons. Scenario 7. Strong borrower with weak economic conditions. Riverside Manufacturing, Inc. is a mid-size manufacturing firm operating for 12 years and are requesting a loan for $250,000 to expand production capacity by purchasing new machinery and are asking for a 10-year commercial equipment loan. Riverside's 5 C's Walkthrough. Character. The company has an excellent credit history, long-standing lender relationships, and no prior defaults. Capacity. Historically strong cash flow, but recent revenues have declined due to a broader economic slowdown. Capital. Owners are contributing additional equity toward the equipment purchase. Collateral. New machinery and existing business assets secure the loan. Conditions. The economy is experiencing a downturn, and demand in the manufacturing sector is uncertain. Strongest and weakest C's. Strongest C, character. Weakest C, conditions, economic environment. Lender decision, approve with conditions or modify loan terms. Even strong borrowers face tighter lending standards during economic downturns. A lender may approve a smaller loan amount, require additional collateral, or charge a higher interest rate to offset economic risk. As you've seen, lenders rarely rely on just one C when making credit decisions. Instead, they carefully balance strengths and weaknesses across all 5 factors: character, capacity, capital, collateral, and conditions. A borrower may have strong income but poor credit history. Another may have excellent collateral but temporary cash flow challenges. In many cases, a weakness in one area can be offset by strength in another, but not always. Lenders also don't just evaluate the borrower, they evaluate the environment around the borrower. Economic conditions, industry trends, and the purpose of the loan all influence whether a loan is approved, denied, or approved with conditions. That's why many real-world lending decisions fall into the middle ground. Not a simple yes or no, but an approval with adjusted terms, such as a higher interest rate, additional collateral, a smaller loan amount, or a shorter repayment period. The goal for lenders is not to avoid all risk, but to manage risk responsibly. There is rarely one perfect answer, but there is sound financial reasoning.